We are continuing to follow the latest on Twitter founder Jack Dorsey stepping down as CEO and the impact that might have on investors. A big part of the move, Elliott Management. And for that, Leslie Pickard joins us with more. Leslie.
Hey, Andrew, that's right. From Elliott's perspective, the management change at Twitter was really 2 years, at least, in the making. Spearheaded by managing partner Jesse Cohn, Elliott had been pushing to remove Jack Dorsey from the CEO role over concerns that his time was too stretched while also managing Square. Elliott went so far as to nominate 4 directors to Twitter's board, although ultimately they settled, adding Cohn and 2 others to the board. But as part of that ceasefire, Dorsey was able to keep his job, at least in the short term. I was reading through an 8K from March of 2020, and the board at the time agreed to form an independent 5-person committee to focus on the company's leadership structure, including the CEO succession plan and corporate governance practices. That was part of the settlement that they had with Elliott. In June of this year, though, Cohn actually stepped down from the Twitter board, and it's unclear exactly how much Elliott beneficially owns at this time. Reportedly, the firm had been buying on a summertime dip, and public filings show it's still a top investor. In a statement, Cohn applauded the move. This was yesterday, saying the firm's, quote, collaboration with Jack and the company for the past 2 years has been productive and effective. He goes on to say, having gotten to know both the incoming chairman, Brett Taylor, and incoming CEO, Parag Agrawal, we are confident that they are the right leaders for Twitter at this pivotal moment for the company. Now, Twitter shares up 40% since Elliott's stake became public, underperforming the market by about 16 percentage points. Andrew.
Okay, so Leslie, let's try to just cut through it. So Jack Dorsey says he's resigning and stepping down on his own volition. Elliott seems to be saying something else. Which is it?
It's probably a combination of both, if I were to guess here. Given that settlement also encompassed this special committee on the board that had to constantly be reassessing leadership and making sure things were in line. I mean, that is a lot of scrutiny for someone who is a CEO, much more than your average company. So when you have that in place, yes, he got to keep his job in the short run, but there was also this extra focus on his leadership style and corporate governance here. You can see how, seeing the company through this pandemic, not that we're by any means on the other side of it. However, things have at least stabilized from investor standpoint. So perhaps they both agreed it was time for a change there.
Shepard Smith here. Thanks for watching CNBC on YouTube.